Greetings, Dr. Jeffrey Scott here, and this is my weekend market update for January 1st, 2023. Happy New Year's to everybody. Well, could have been a lot happier if Michigan came back to win at the end. I'm a Michigan grad, but it was a great game and exciting season. At least the season was good because this was a tough market in 2022. I titled this week's video, Will the Fed Get It Right? Because I think that's the major question. The biggest concern I think out there is that the Fed will be late to pause, late to ease, and that the economy will go into a recession and then the Fed will have to play catch up because that's usually what happens. And remember, this is the Fed that said we're going to be over 5% at the end of the year in 2023, but it's the same people that said we'd be 1% at the end of 2022. So I think that they will continue to adjust, and maybe they'll get it right, and maybe February will be the last increase in the interest rates before the Fed starts to give a chance for all the prior raises to work their way through the economy. Email address is hgsidoc@gmail.com. If you're new to my channel on YouTube, hit the subscribe button, hit the alarm, and that way you'll get notified when I do these. I try and do them every weekend, at least for the time being. I've been doing them for, probably 20 years. I've got nothing to sell you, so I just education, and it's a lot of my ranting and raving of what I think is going on in the current markets. As always, this is for educational purposes only. Anything I talk about, any stocks, options, whatever I might mention should be considered educational alone and not investment advice. I'm a doctor, not a broker. I am independent. By that means I don't work for any third party. I don't work for any education company. The tools I demonstrate I paid for, and trading involves risk, and you are solely responsible for any investment decisions you make. I do get the honor of speaking at what I think is one of the most enjoyable events of the year, which is the quarterly Wealth 365 summits. It's unusual that I get to speak there because most of the people have websites and sell you a lot of packages, but I've got to know Rob Hoffman over the last couple of years. I've been a user of Wealthcharts for a long time, and I look forward to talking to you all. I think the first day is the 16th of January, Monday, which is also holiday, and then I'll be speaking on Monday and again on Saturday. I'll put the link to register under the video in YouTube. I always like to look at where the major markets are. This is just a view I use in HGSI that gives me the major indexes or ETFs, the sectors, and what I really pay attention to is how far off the 52-week highs we are, and then how far we are off the lows. And the message here, there's a couple of things. First of all, if you look at 5-day performance and you look at the yellow bars, which are the major indexes, we were mixed. The Dow was up 0.3%, the NYSE 0.7%, the Spiders and the Russell 0.4%, and the NASDAQ was down a teeny bit. Now, keep in mind that's a 5-day return, and the market was only open 4 days on the week, just like it only have 4 days this coming week. But I thought 5 days was important because that really is the Santa Claus rally, 5 days in December, 2 days in January. So I'm not sure Santa's actually come yet for the markets. Certainly wasn't a very negative week. And you could see on Friday that although the markets rallied later in the day and made up for some of the losses, it still was a red day pretty much across the board for all the major indices. Now, you can see over here the 52-week low on the major indices was October 13th, 78 days since then, and you could see that we ranged from 3 to 4% on the technology-laden Qs, and NASDAQ up to 15% off the bottom on the diamonds. So the markets have had a big move, and we'll see whether we go down and retest that level or go further. On the sectors, you could see that healthcare led on the last year, only down 5%, energy minus 7%. But when you look at some of the technology-laden communication, technology sector and discretionary, big losses to the bottom of 30 to 40%. Now, this past week, I was surprised to see the rates start to move back up. Maybe I shouldn't be surprised. And that probably spooked Santa some. Um, Rising rates could reduce growth, and that would be something that the markets would probably not appreciate. Is there a recession in our near future? You could look at things like the credit risk or how tough it is to get credit, and you could see that when we move up, it's often followed or occurs during a recession, tight money. And we've moved up above the levels that we were at in 2018, and that was associated with a slowdown in the market. If you look over at the yield curve, some folks pointed out that we didn't see the yield inversion in 2020. Well, that was true on the 2 versus 10, but some people look at the 3 versus 10, and we did see a yield inversion there. And it's just we're profoundly below the zero line on both of these yield curves, and we've been below for quite some time. And typically, you get your recession after you recover the zero line. Breadth didn't do much this week. Stocks above the 200 in white, stocks above the 40 in white, really unchanged. 12-week new high, new low. We did see it run up some on the week, but that's a real short-term indicator. The buckets, this is where we were a week ago. This is where we are now. Really look the same to me. Still a bearish with 67% of the stocks below the midline or the Bollinger Bands, maybe a few points better than it was a week ago. But what I really look for is what I call a shift. So I have a lot of stocks below or a lot of stocks above. Don't see it, no signal here. Doesn't give me a direction of the market. Now, if you're an HDSI user, you might notice that you saw a Hindenburg Omen this week. And it sort of surprised me. It's not replicated in EdgeRater or some of the other tools that I use. And I went back and looked, and you can get spurious Hindenburgs even well off the highs during a bear market rally. But when I tried to look at, did they signify the end of the bear? Was it going up or going down afterwards? I really couldn't see consistency, so I'm going to ignore it. But I do look at the new lows, and perhaps it's just because of the light trading days. But even on the NASDAQ, we dropped from double-digit new lows to a little bit over 2.5%. And on the NYSE, the new lows dropped at the end of the week. It would be nice to see some of these green new highs to pop up. We haven't seen them in quite some time. Now, in EdgeRater and HDSI combined, there's this great ability, and it's to ask questions about what drove the market. So every weekend, I do a dump of the HDSI database into an HTML file, which you can import into an Excel spreadsheet. Now, EdgeRater takes that HTML file, and you can ask questions like, was this market, did you do better with earnings versus no earnings? And last week, yeah, you actually did better if you had a high earnings per share rank. Did relative strength rank matter? Actually, it was a negative. The stocks with no relative strength going into the week actually outperformed. So that's interesting. So it was not a growth-driven week. Some of the stocks distributing the week before had the best performance. And you notice that despite the fact the major indices were negative, most of the broad market was up a very small amount. Now I can take the same thing, but using a snapshot of the market from January 1st of 2022 and ask how did the market do going forward based upon what we saw there. Now you could see everything's below zero. Obviously it was a very difficult year. Earnings per share rate, you know what? Having earnings didn't do better in 2022. Isn't that interesting? Relative strength rank, yeah, you did poorly no matter where you were, but for the year, having relative strength actually outperformed, meaning you had less negative. And stocks that were accumulating going into the year actually did better than those that were distributing. But to me, the story is right here, which is pretty much everything is negative, and some of the groups being down 30, 40%. Now, I typically am a growth guy. which means I'm looking for high relative strength, high earnings per share rank, and typically those are the stocks that lead. Now, I asked the question going back looking from the January 1st close to the December 30th close, and I looked at data that was available to me on January 1st, 2022, specifically looking at the EPS ranks, relative strength rank, and group rank, and looking at required 280. So you could see that all my EPS ranks are 88, here's an 83 and 88, 89, the rest are 90 and higher. Relative strength rank is above 90 on all of them, and group rank is pretty close to the top as well. Now, the scary thing about 2022 is these were the leaders coming into them, and some of these are well known: NVIDIA, Rambus, Nucor Steel, On Semiconductor, Cook and so for a lot of technology stocks. And only 5 of these stocks were up in 2022. So these were the leading stocks at the end of 21. There's a couple of messages there. One, growth didn't work this year, and these were high growth stocks, and they underperformed. Look at the number of semiconductors that were leading based upon 2021 performance. Another message here is that things that led in the past are not always the things that lead in the next run. So we may not see these as leaders going forward. You need to know your news and your earnings, and this week probably the big event is the FOMC minutes, and it'll be interesting to see the tone, whether it's more or less hawkish than Powell's press conference. Then we got a bunch of employment numbers. So it's a big week on news. And then what we're going to see in earnings, a few things coming in end of the week. Richardson Electronics, which was actually one of the stocks that was up 60% in 2022, actually has earnings on Thursday. AEHR was also on that list. As I said right here, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Now, I haven't shown this in the last couple of weeks. I fear that by now most people know how to do this themselves. But this is an expected move chart. It's got the E-minis, the NASDAQ, the Russell, the Dow, then the Russell down here, the VIX, and the dollar. And you get a sense by looking, and it was a short week, only 4 trading days, what the market did. So the gray line is where the market closed the prior week. And if you look at it, the S&P traded down to the bottom of the expected move and closed right on where it opened. You look at the NASDAQ, similar story. You look at the Dow, similar story. You look at the Russell, maybe a little bit up on the week and not much movement on the Dow, and the dollar was down a tad. Now, the expected moves are calculated by looking at what it would cost to buy a call and buy a put at the same strike price close to where the market ended the prior week. So if you thought there was a big move coming, a volatility event, but you didn't know which way, you could buy both of those. And as long as the market moved more than the combination of the 2 premiums you paid, you would make money. Now, the smart money sells those options, and so typically the option market makers, who are some of the smartest people in the market, will price them so that 80-85% of the time you finish within the green and the red line. So the green line would be the premium on the call plus the premium on the put added to the strike price. The red line would be the premium on the call, the premium on the put subtracted from the strike price. And if you end up anywhere between the two, the option makers made money. Now, if you end up adjacent to the green or the red, it's a push on the person that bought the options. So markets remained under pressure, continued weakness in some of the beaten up names. Clearly some tax loss selling, although that should have ended on Wednesday. Santa Claus rally, not much yet, but we'll see what happens. Bump in yields that I showed you probably was bad for growth. You can see Russell 3000 growth fell by 0.3% and is down nearly 30% on the year compared to the Russell 3000 value, which actually was up on the week and only down 10% on the year. So 2 more days, Tuesday and Wednesday, coming up January 3rd and 4th, to see whether or not we got a Santa rally. I still think cash is a good position. Short term will continue to bounce off support, but on longer term charts, it doesn't look like we are anywhere near a bottom. I am looking for a sell off again, at least another leg down. A successful retest of those October lows, which are still 15% away for the Dow, would be a pretty strong move to give me some conviction to start thinking that maybe it's time to start taking more longer positions. But a breakdown between those October lows, and I do think that the pre-bear market 2020 highs will be in play. Look for some additional color from the Fed in their minutes. And for those that are looking for a lottery pick, Netflix earnings are in 3 weeks. And when you look at the chart, considering it's big cap tech, Netflix actually looks better than many of the others. And we'll take a look at that. And just to remind you, two thoughts that I'll probably take this off going forward. The first thing is the blue lines define the market bottoms going back to the 70s. And the market bottoms occur when the black line turns down, which is rates. So you need a rate cut to really show you that we're near a bottom or at a bottom. The other thing is I'm going to show you 3 spots. Right here, this black dot is where we are in the current bear market. This black box is the average bear market. And if you look at 2 things, how big of a loss and how long. So we're not even to average yet. Getting closer. The second thing I want to show you is the red box, and that's what you'd expect to see if we go into a recession. So hopefully we don't go into a recession, and hopefully we get that leg down quickly and then we recover and go on to new highs and be bulls again. But if this market, if we see a recession, I think the market rolling over is probably in the cards. And again, hope to see you at the Wealth 365 event. If you don't have wealth charts, it's worth coming to look around. Rob spends every night going over some of the highlights of the program. The only thing I have in this world that I sell is probably the Wealthcharts add-on. Maybe some more things to come before too long. And what you find at the Wealth 365 summits is that it's the lowest price of the year typically to buy Wealthcharts, and all of us that have add-ons have special offerings as well. All right, let's go take a look at the charts. I don't think I'm going to be spending hours looking at charts today. I've done that already, and I think you probably already are well aware that this is not a rip-roaring bull market where there's hundreds of things to look at. So I start with the Wealth Scanner, looking at only for hot stocks with the flames. And the first thing you notice is aerospace and defense. So things like Raytheon, Lockheed Martin looked interesting when I looked through some of the charts. Reality, they're going sideways and have been going sideways now for about 5-6 weeks. But the flame there tells me that they had a big move. The downside is when you look at the numbers here, none of them are in really strong groups. So when you're starting to see a flame on ARKK, that's interesting as well. But I really think that it's bouncing off the bottoms, and I'd rather look for groups where I have 600, 700, and 800 for the wealth score. Now, if I go into the indices, notice what you see here, sideways move for the last couple of weeks. In fact, if I look at the weekly, you'll see 2 dojis, one after another at the prior week's low. So the markets have done nothing in 2 weeks. They've gone sideways. You look at the Qs, similar pattern, clearly the same pattern on the diamond, same pattern on the Russell. The VIX really hasn't done much, sideways movement, and the dollar is sideways. So it's almost as if the markets are waiting for a message of which way to go. I have my thoughts. Now, I could almost make an argument that this is a bear flag, and that when we break below, the market's likely to go down 60% of the move down from that white line. But I'll hold that thought for right now. I don't think it's got enough upward angle to meet that criteria. If I look at commodities, you'll notice that with the weak dollar, gold has had a nice move up. Silver leading gold, even oil did well, and In the words of Mr. Wonderful, natural gas is dead to me. Natural gas has dropped from the 34, 35 down to 14, whipsawed by geopolitical events in Europe. And then something that might be considered concerning is it's the fact that interest rates, which had, like the dollar, softened, are starting to head up. And maybe that should be telling us something about where the Fed is and what's likely to happen. Now, it'd be nice if it was telling us that it's all clear in the economy, but I don't think that's what that's telling me. But rising rates, concerning because that will hurt growth. Weekly market signals, this is my weekly timing tool. It requires two things to be in a buy: price above the 30-week WMA and a green weekly bongo. To be in a sell, price below in a red weekly bongo. And if you have one of the two, then it's more of a hold. So looking at that, the spiders, the Qs, and the Russell are all in, well, they're not in buy mode. And the only thing that's holding up, and we'll see if it can maintain that, is the diamonds. But they've come off their highs already as well. Now, clearly you should expect large cap and value because it's a defensive market, and that's what we see when we look at large caps versus small caps, growth versus value. And when we look at the hourly S&P sectors, just to see which one short term might be outperforming. So I'm really looking for two things. I'm looking for things that are pointing up to the upper right hand corner and those that might have had a long blue bar as strength. So materials weekend, communications is weak, energy is fighting its way back, as is financials. Industrials has been doing well, technology sold off. Staples eased on Friday, but have been strong, as is healthcare. Discretionary, not where you want to be right now, unless the market's turning. Utilities had also been doing well, defensive. Real estate not matching the other defensive plays, and probably because of the interest rates. And there's a lot of, what's the word I would say, a lot of office space in a lot of malls that people are concerned about. If we look at my buy signals, we'll just start with the heat map on Friday. So it's interesting, as I mentioned before, that even though the indices were kind of flat on the week and down on Friday, there were a lot of stocks that were up. And so you can see a pretty mixed picture there. If we look at Wealth Scanner, get a sense of what's working. The thing I don't like is, I've only got a couple things that are above 600. I've got bearish dollar. Okay, we know the dollar's weak. I've got gold, which here's GLD, and certainly something that would make sense to have a position in, or in a gold or silver stock. And then the other one above 600 is the social, probably being driven by Meta's recovery and perhaps potential gains if TikTok goes down. I don't expect to show you a lot of buys, to be honest, and you shouldn't expect them with this current market. But if I go into CAT Scanner, I look at my combo leaders. Now, I've got this set up, and you'll notice that everything's green under the bongos, is I've got it set up with my price and my volume, and then I want stocks that have reversed to the upside on the daily within 9 days, and I want to make sure the daily and the weekly bongo are bullish. I'm going to hit apply, and what you see are not a lot of stocks. You get down, if you're looking at 2 and above, you got like 10 stocks. That's a very small number. It's consistent with the weak market. Now, a lot of what you're going to see are things like FSTX. And FSTX is a low-cost biotech. And these are the things that have been working this week. They're tough for me to play. There's too much news risk from medical meetings, clinical trial reports that come out sporadically, PDUFA dates. You really got to know what you're doing. So it's okay to trade them, but you got to be careful. Now, the volume here is interesting. Now, one that did break out and have a big week was KALA, But again, this one is very similar to what happened with Intercept Pharma maybe 5 years ago when it ran from about 50 to 500 and now it trades at $10. It has some new therapies with some promising data, but it doesn't have anything in the market. It's a high risk play. And both of these are probably a little bit insane, in my opinion, but I don't know enough about the companies to say that they're not real or anything like that. Now, if you want to play biotech, why don't you pick something that's got revenue and growing its earnings? And that's CTI Biopharma. Um, I, I always think of this one as a potential takeout play, but what I wanted to show you is what happened here in February because, and I like picking on my mini-me at work because I think sometimes he'll listen to these. Um, and he's an oncologist that works with me, and we were both in CTI. Now, notice CTI, this red bar here, which was February 28th, that was the day of the PDUFA date. The PDUFA date is when the drug either gets approved or denied by the FDA. Now, typically those announcements occur after the market is closed or the stock is held, so there's no trading in the stock. So you can't really trade it immediately on the news, and then everybody finds out, and the stock turns on. Well, as you could see, on the day of the approval, it actually sold off. So you could have gotten into the stock for $2. The stock ultimately went up to about $7.80 before it ultimately reversed. So one of the first things to point out here is that you could have bought it on the open the next day or the following day and not had the risk of a denial. The second thing is don't sell it the day it gets approved or the day after because typically it runs for a while. Now, I actually know this company well. We do some work with them. I'm not an insider. I don't know anything current that's not public. But what I see is a stock that's now gone sideways, squeezing, and has had two of these green dots above the squeeze signal in a row. That's the kahuna force. And two kahunas in a row is something that I pay attention to. So we had an EMS signal on Thursday, two kahunas in a row, increased volume, breakout, relative strength in OBV. I think CTIC looks interesting here. Another interesting stock, and it's one of these that Kramer used to pick on as being these high dividend payers because their prices get chopped. EC, I think it's a South American, but don't hold me to that, integrated oil play. So it's got midstream, refining, exploration. Its dividend, if it holds it, is above 20% because the stock has come down. But here's a stock, strong oil markets, breakout on big volume here. Look at where relative strength and OBV have been moving now for days. And that one looked interesting to me as well. Now, I'm being very careful with my own account. I still think cash makes a lot of sense. But even when I'm in cash, it doesn't mean I'm not taking some small plays to the short side and or the long side. Now, if I go to my weekly short watch list and I do a similar thing here, let's actually, that's not my, I'll go to the weekend short review, this one, and look at by dots. See, I got green ones here, so I got to fix that. So I go into my filter, and I like to short stocks that are a little bit more expensive. So I got to be at least 25 bucks. I don't like shorting a $10 stock. I want volume to be a lot, so I want at least 500,000 shares on average. I want to make sure that I don't have any bullish dots, so I'm going to put less than or equal to 0. Then I'm going to go to bearish dots. I want at least one of these. So if I'm looking for bearish plays, I want to find a bearish impulse. And then let's give it the 9 bars to reverse to the downside. Now, why 9? Because the 2 weeks ago was 5 days. Last week was 4. So that would be the last 2 weeks. And then I want to go Bongo daily bearish, Bongo weekly bearish. Now I'm going to hit apply, and you're going to see very few stocks. So 2 of these, actually 3 are the stocks that I actually thought were interesting to put on my screening list. And what I do is I put together a list of longs and shorts. And I don't necessarily take all those trades. I might put one or two on, or at least work them up and have some orders if the stock moves the right way. But I like to watch a large number to see how the market actually is going. And if I see all my shorts going up, I know I don't want to be short in the market. So WEC, I think this is Wisconsin Energy, run up, failed at the 200, failed at the 200 again, now is failing at the 17 and the 50. I think this is one that could potentially come down 10 points, which is over 10%, and start to retest its prior lows. Notice that relative strength and OBV have turned down. You have the kahuna to the downside and a breakdown. All three bongos are red. UPS, you would think this is a good time of year for them, but look at UPS breaking down below the 50. Now it's got a bottoming tail there, so I'd love to see if it runs up and then fails again before I would short it. And then a company or a restaurant that I've never understood, Texas Roadhouse, is one that has had a really strong move this year going back to May. Not quite a double. It looks like it's rolling over as well. So those are some things to the long side and short side I'll be looking at. Cash is a great position. Let's see if we get any Santa on Wednesday and Tuesday. And then lastly, I mentioned Netflix. So let me just give you some stats on Netflix. So this is where we are right now. This will be January 3rd, which will be the next trading day. This is the end of the month. You have to know when earnings are, and it's the week. It's the week that we're having, I believe, the back half of the week that we're having the event at, but you have to check that and make sure. This line here would be the projected earnings. I think that's a 5-year line of what we might see based upon history. History tells me it's up 7 out of 10 times between the 3rd and the 31st with an average of 12.6%. In the years that it's positive, it's really positive, 26.93 average, maximum 74%. But you could see last year really broke the apple cart. It was down a lot. So you have to be careful. I often play these with options, and maybe as we get closer, we could talk about those. Here is a weekly chart, and then this is a 10 and 15-year projection of where price is likely to go. Now, when do you buy Netflix? Well, let's just look at the Netflix chart, and you'll see that compared to some of the other stocks in the market, Netflix doesn't look bad at all. In fact, I think I drew this channel back when I was at my live meeting earlier in the month. This would be around the 5th here of December. So were we in the channel? Yeah. And I think I talked about buying it at the bottom of the channel. Well, we're at the bottom of the channel. We are clearly in an uptrend. We've got a bottoming tail on the weekly chart. I wouldn't get it. Maybe I'd set my stop here, maybe the bottom of this bar. But if we trade above this channel or into the channel, I might start to nibble a little bit on Netflix early. That's just my approach. I know a lot of folks would rather wait until we get within days of the earnings play so they know what price we're starting at so they can pick their stock prices. And remember, these are going to be expensive options because a lot of people play this. So on that note, have an awesome New Year's, what's left of it. I'm going to go watch Ohio State. Maybe they'll do better than my Wolverines. And talk to you next week.